Welcome to the Explainer. Today, we're unlocking a really powerful, step-by-step framework designed to take you from a complete beginner to an advanced practitioner of a highly effective 15-minute scalping strategy. We're going to be using smart money concepts, or SMC, combined with pure price action. Now, if you've ever felt completely overwhelmed by market noise, or maybe you've struggled to find those precise, low-risk entry points, you're in exactly the right place. We're going to break down how to read the market's true intentions and trade alongside the big institutions rather than getting crushed against them. Let's get right into it.
Okay, let's dive into this top-down execution playbook. We're going to cover the SMC scalping master plan, mapping market structure, finding precision entries, setting stops and targets, mastering risk and psychology, and finally wrap up with the pre-trade checklist. Section 1, the SMC scalping master plan, the top-down approach. So the absolute core of this strategy relies on a multi-timeframe perspective. Think of yourself like a commercial airline pilot going through a highly structured, absolutely non-negotiable pre-flight sequence. You don't just jump into the cockpit, mash the throttle, and hope for the best. First, you look at the macro view, right? That's our 15-minute chart. This is exactly where you determine the overall market direction and structural bias. Once you have a crystal clear picture of the weather up at 30,000 feet, then, and only then, you drop down to the micro view, which is the 5-minute chart. The 5-minute chart is your runway. It's where you patiently sit and wait for those precise, high-probability entry confirmations that offer incredibly low risk. By combining these two timeframes, we literally filter out all the chaotic noise and align ourselves with the dominant momentum. Section 2. Mapping the market structure. Finding your bearings. When you open your 15-minute chart, your very first job, your absolute priority, is to establish the market structure. Doing this simplifies your decision-making instantly. If the market is printing higher highs and higher lows, you really only have one job. Look for buy opportunities, nothing else. Conversely, if you're seeing lower highs and lower lows, you are strictly hunting for sell opportunities. And this brings us to the absolute golden rule of this explainer. Never, ever trade against the trend. You see, the trend is basically the footprint of institutional money, and our whole goal here is just to follow their tracks. Now, to accurately track that trend, you really need to understand two vital smart money concepts. Let's start with the break of structure, or BOS. A break of structure happens when the price violently pushes past a previous swing high in an uptrend or a previous swing low in a downtrend. So, why does this matter? Well, because a BOS confirms that the current momentum is strong and the trend is continuing. It's the market telling you, hey, the buyers or sellers who were in control a minute ago are still very much in the driver's seat right now. On the flip side of that, we have the change of character, which is commonly known as a COC. Contrast this with the boss we just talked about. A COC happens when the price actually fails to continue its trend and instead breaks structure in the exact opposite direction. Think about it. If you're in a steady uptrend and suddenly the price just tanks below a major recent low, well, that's a change of character. It is a massive warning sign. It signals that the market trend might be flipping and control is shifting from buyers to sellers or vice versa. The key here? In our strategy, we never try to predict these moves before they happen. We only wait for the COC to actually confirm them. Okay, so once you've identified your trend and your structural breaks on that 15-minute chart, you need to mark your points of interest. These are essentially the hidden zones where massive financial institutions often leave their limit orders resting. You absolutely want to highlight traditional support and resistance, for sure. But you also want to draw boxes around order blocks, that last opposite colored candle right before a really strong move, and fair value gaps, which are those obvious imbalances in the price action. Finally, map out your liquidity areas, which are usually resting right above old highs or just below old lows. These marked zones on your 15-minute map, they become the primary battlegrounds where we're going to look for our entries. Section 3. Finding your precision entry. Zooming in to the 5-minute chart. Now, this is where the narrative energy completely shifts. We've mapped our terrain, right? Now we zoom down into the 5-minute chart and we hunt. This is the exact moment where you must exercise extreme patience. When the price finally reaches one of those important 15-minute zones you just marked, a lot of beginners will panic and just smash the buy or sell button immediately because of FOMO. Do not do that. Instead, wait for the price to actually tap the zone. Then, looking at the 5-minute chart, you want to look for a new break of structure or a change of character to confirm the reaction. Look for really strong rejection wicks or engulfing candles. And finally, double-check that a volume increase is validating the move. Guys, these are your absolute mandatory confirmations. And this brilliantly illustrates the exact entry criteria mechanics for both scenarios. For a buy trade, you wait patiently until the price taps a bullish order block or fair value gap on your 15-minute map. Then, you drop to the 5-minute chart, you wait for an upward break of structure, and only then do you enter. For a sell trade, it's literally the exact inverse. Wait until the price reaches a key resistance zone or a bearish order block. Keep your eyes on the 5-minute chart for a downward change of character or a downward BOS, and then you strike. You see what we're doing here? You're letting the market fully prove its intentions to you before you risk a single dime.
Section 4. Setting stops and targets. Protecting your capital.
Entering the trade is honestly only half the battle. Now we have to shift into defense mode. Because the primary job of a trader isn't actually making money, it's protecting your capital. Your stop-loss placement has to be structural and incredibly strict. For a buy trade, place your stop-loss strictly below the recent swing low. For a sell trade, it goes strictly above the recent swing high. And let me give you a cardinal rule here. Never, ever, under any circumstances, move your stop-loss farther away to give a losing trade more room to breathe. No way. You absolutely must accept small losses as just another business expense in your trading career.
Now listen to me closely on this one. 1 to 1.5. This is a critical mathematical rule for this strategy. It is your minimum risk-to-reward ratio. For every single dollar you risk on a trade, your setup must offer the clear potential to make at least $1.50 in profit. If the distance to your target just doesn't allow for a 1 to 1.5 ratio, you simply do not take the trade, period. It's really that simple. Math is the engine that gives this strategy its long-term edge.
So how exactly do we capture that reward? Well, we scale out strategically. As the price moves in your favor, you should seriously consider securing profits in phases. Take profit 1 could be hit at a 1-to-1 ratio, which basically ensures you don't walk away empty-handed if things turn around. Take profit 2, that's your core target right there at the 1 to 1.5 ratio. And hey, if the momentum is really ripping, you can leave a runner for take profit 3 at a 1 to 2 ratio or even higher. And the most logical places to set these targets? Exactly. Those liquidity zones we talked about earlier, those old highs and lows where everyone else's stop losses are resting.
Section 5. Mastering risk and psychology, the golden rules of survival.
So the crucial point is this. The absolute non-negotiable rule of survival is 1%. Look, if you implement all the smart money concepts perfectly, flawless execution, but you fail to manage your risk, you will still completely blow up your account. It's just a matter of time. You must risk a maximum of 1% of your total trading capital per trade. By keeping your risk this incredibly small, a string of 3 or 4 inevitable losses won't devastate your account balance, and way more importantly, it won't devastate your mindset.
And speaking of mindset, you absolutely must avoid the psychological traps that just routinely destroy beginner accounts. Things like trading without that 5-minute confirmation because you're terrified of missing out, or ignoring the 15-minute higher time frame entirely and just getting chopped to pieces in the noise. Entering way too early, risking way more than 1% to magically make up for a previous loss, which, by the way, is known as revenge trading, and it's a killer. Chasing those huge aggressive candles after the move has literally already happened, or trying to trade during dead low-volume hours. We've all been there. Recognize these mistakes, acknowledge them, and pledge to ruthlessly cut them out of your routine right now to avoid overtrading.
Section 6. The pre-trade checklist. Your final step.
All right. This is the ultimate pre-flight checklist. Before you ever even think about clicking buy or sell, you must interrogate your own setup. Ask yourself, have I clearly identified the 15-minute trend? Have I actually waited for a break of structure or change of character on the 5-minute chart? Am I reacting off a properly marked order block or fair value gap? Has a liquidity sweep happened yet? Does the trading volume actually confirm this move? Am I risking exactly 1%? And finally, is the risk-to-reward ratio at least 1 to 1.5? Listen to me. If and only if every single one of these answers is a confident, undeniable yes, do you have permission to enter the trade?
Remember, consistency always beats emotion. Trading is not about taking as many trades as possible. It's about waiting patiently for high-probability setups. Just one good, checklist-approved trade is infinitely better than 5 poor, rushed ones. You are not paid to click buttons all day. You are paid to wait. You are heavily compensated for your patience and your iron discipline in executing this exact master plan.
To wrap up our explainer today, I need to read this exactly. This content is for educational and informational purposes only and should not be considered financial or investment advice.
always do your own research and manage your risk before trading. Thank you so much for joining me today. You now have the full playbook in your hands, but the real question you got to ask yourself is, do you have the discipline to wait for the perfect setup on your very next trade?